Welcome to the Deep Dive. We're the show that cuts through the jargon of complex business reports.
We try to find the real story, the strategy behind the numbers.
Exactly. Because for businesses, numbers really do tell a story, don't they? They show where a company's been and maybe where it's headed.
And that's what we're doing today.
Right. Today we're taking a close look at JSW Energy Limited. Specifically, their financial and operational results for the quarter ending June 30th, 2025. That's their Q1 FY26.
Yeah, and we've gone through quite a bit of material, their official presentation, the regulatory filings, press releases, the works.
Our goal here is pretty simple. Pull out the key insights, help you understand not just what happened, but why it matters.
And what it might mean for JSW Energy and, well, the whole Indian energy scene.
Okay, so let's jump right in. JSW Energy's Q1 results, they look big.
Yeah.
I mean, really big.
Yeah.
Record-breaking seems to be the word. What's the headline story here?
Record-breaking is definitely the right term. And it's not just big numbers for the sake of it. They seem to signal a real shift, maybe an inflection point for the company.
Okay.
So look at the reported EBITDA that surged 93% year over year. 93%. That's 3,057 crore.
Wow.
And profit after tax, the PAT, that climbed 42% year over year to 743 crore. Even more striking, maybe, is cash paid up 65% to 1,579 crore.
Huge jumps across the board.
Right. Total revenue also saw a massive 78% year-over-year increase, hitting 5,411 crore. And if you track earnings per share, the diluted EPS went from 3.0 last year to 4.25 this quarter.
So connecting that to the bigger picture.
Yeah.
This isn't just incremental growth. It feels like something fundamental changed.
Exactly. It suggests they're hitting a new level of performance, probably a mix of integrating assets well and running things efficiently.
And their CEO, Mr. Sharad Mahendra, he actually called it an inflection point, didn't he? He said it was driven by disciplined investment strategy and sustained CapEx.
Yes, and that sustained CapEx part is crucial when you look at their ambition.
Right, the targets are, well, staggering. A cumulative CapEx of around 1,030,000 crore.
1,30,000 crore. It's enormous.
To reach 30 gigawatts of generation capacity and 40 gigawatts of energy storage by FY 2030. What does that kind of spending tell us?
Well, two main things, I think. First, huge confidence. Confidence in India's energy needs growing, and confidence in their ability to grab a big piece of that pie, especially renewables.
Makes sense. And the second
The second is their focus on quality of earnings. They keep mentioning a higher share of tied-up capacity.
meaning long-term contracts.
The TPAs,
Exactly.
power purchase agreements. In a business that's capital-intensive, locking in long-term buyers for your power gives you stable, predictable income.
Which you absolutely need if you're planning to spend 1,030,000 crore.
Precisely. It reduces risk. It insulates them from the ups and downs of the short-term market. It's a smart way to fund that massive expansion.
Okay, that makes a lot of sense. Predictability is key for those huge investments. But let's get into the nuts and bolts. How did they actually generate all this growth this quarter? Let's look at the operational side.
Yeah, good question. Because it wasn't just things ticking along nicely, it was fueled by some big moves acquisitions, plus getting new capacity up and running fast.
Okay, so what are the key numbers there?
Well, their total installed capacity shot up by about 70% year over year. They ended the quarter at 12,768 milliW.
70%.
Yeah. And a big chunk of that, 1.9 DW, was added just in this quarter. About 1,343 milliW of that came from acquiring O2 Power.
We'll come back to that one. What about actual generation?
Net generation for Q1 was up 71% year over year. That's 13.5 billion units, or BUs.
And how does that break down? Thermal versus renewable?
Renewables were up 54% year over year, hitting 5.0 BUs. But thermal saw an even bigger jump, up 83% to 8.5 BUs, a lot of that driven by new assets coming online.
And you mentioned those long-term contracts again.
Yes, the generation tied up under long-term PPAs increased 73% year over year to 11.8 BUs. That really backs up that quality of earnings point we discussed.
Yeah.
Stable base.
Right, so acquisitions were clearly a major driver. Can you walk us through some of the key ones?
Absolutely. Let's start with Mahanadi. That's the 1,800 milliW thermal plant they acquired back in March 2025.
Okay.
In Q1, it generated 2.7 BUs and contributed a pretty hefty 867 crore to EBITDA. And significantly, they got NCLT approval for its debt settlement, which helps clear the decks financially.
Okay, that's Mahanadi. What else?
Then there's the big one, O2 Power. That acquisition closed on April 9th. It's a 4.7 GW renewable platform.
4.7 GW, wow.
Yeah. And in Q1, it added 768 million units of generation and 219 crore to EBITDA. What's really interesting about O2 Power is its mix.
How so?
It's not just plain solar or wind, it includes solar, wind, hybrid projects, and importantly, what they call complex solutions like FDRE and RTC.
FDRE and RTC.
Firm and dispatchable renewable energy, and round-the-clock power. Basically, combining renewables, maybe with storage, to provide reliable power not just when the sun shines or wind blows, it's more valuable.
Got it. More like traditional power, but green.
In a way, yes. And O2 Power has PPAs with good quality counterparties.
Okay. Any other key operational points?
Yeah, a couple more. The Vijayanagar plant, that's an imported coal one. They made a strategic shift towards long-term tie-up there.
The PPA strategy again?
Exactly. And its LT generation jumped 124% year over year to 1.3 BUs. Result, stable EBITDA from that plant.
Okay.
And Utkal Unit 2, commissioned in March, it ramped up quickly and generated 370 million units this quarter. Plus, they've just synchronized the first 80 milliW unit of the Kuthur Hydro Plant. That's a 240 milliW project, so more capacity coming online there soon.
And all this activity, these additions,
Yeah.
it shows up in their efficiency metrics too, right?
Hmm.
Plant load factors, PLFs.
Definitely. You mentioned Vijayanagar. Its PLF jumped to 82% this quarter compared to just 43% last year. That's a direct result of securing that long-term PPA.
Clear impact.
And Mahanadi also ran at a healthy 75% PLF. It shows they're not just buying or building assets, they're integrating them, running them well, and finding buyers for the power.
Okay, so the core business is firing on all cylinders. But JSW Energy talks a lot about the future, the energy transition. What's the game plan there? Renewables, storage, hydrogen.
Yeah, this is where you really see their long-term vision. It's not just about today's profits, it's about positioning for tomorrow's energy system.
So renewables first.
They've added over 3 GW of renewable capacity just in the last year. That's huge. And in Q1, they signed more PPAs, 605 milliW, a mix of wind and hybrid.
And they're not stopping there.
Nope. After the quarter ended, they signed another 350 milliW of that FDRE, the dispatchable stuff, and 100 milliW of solar paired with 100 milliwatt of battery storage.
Battery storage, right? BES.
Yes. It all fits into their bigger picture. Growing installed capacity at roughly 20% CAGR until 2030. The target is that massive 30 GW of total locked-in generation capacity. It's a very clear roadmap.
And alongside generation, there's the energy storage piece. You mentioned 40 GWh by 2030. That seems incredibly ambitious.
It is ambitious, but they're already making serious headway. Their current locked-in storage capacity is already 29.4 GWh.
Almost 30 already. Wow.
Yeah, they signed deals for 12.5 GWh just in Q1, plus another 680 milliwatt after the quarter, and that includes both batteries, BESS, and pumped hydro storage.
Okay. Different technologies for storage.
Right. And then there's green hydrogen. They've got that 3,800 tons per annum plant at Vijayanagar. Trial runs are happening now.
So that's moving from plan to reality.
Looks like it. They expect hydrogen and oxygen supply to start very soon.
Okay, that's a lot of expansion, a lot of different technologies. Which brings up the money question again. How do they manage all this financially? Is the balance sheet strong enough?
It's a fair question. And what's interesting is how they seem to be balancing this, aggressive growth with keeping the finances in check.
So what are the key metrics there? Debt levels.
Their consolidated net debt to equity was 2.1x, and the net debt to pro forma steady-state EBITDA, which excludes the assets still being built, was 4.7x.
4.7x. Is that considered healthy in this sector, given the expansion?
In some industries that might seem high, but for a utility investing heavily like JSW Energy, especially with those long-term PPAs providing predictable cash flow, it's generally seen as manageable, even healthy. The idea is that the future earnings from these investments will comfortably cover the debt.
Okay, so the debt level is manageable in context.
Right. And their liquidity looks strong, too. They had over 6,100 crore in cash and cash equivalents at the end of June. Receivables, measured by days sales outstanding, were at a healthy 58 days.
We did see finance costs go up, though, to over 1,300 crore from about 500 crore last year.
True, but that's expected when you borrow more for big CapEx projects and acquisitions. The key thing is they manage the cost of that debt. Their weighted average cost of debt was 8.87%.
Which is pretty decent in the current environment.
Yeah, keeping it below 9% shows good financial management. And they emphasize their cash generation, about 4,019 crore in cash PT over the last 12 months. That translates to a cash return on adjusted net worth of 19%. solid returns.
And they've been successful in raising funds, too.
Very much so. They raised a fully hedged USD 675 million loanable loan, an external commercial borrowing, or ECB, through their subsidiary JSW Neo, 5-year term, and crucially, it got strong credit ratings.
Ratings matter.
Absolutely. ICRA gave it AA, CE stable. Their rupee loans are rated AA stable. That's a strong signal of confidence from the financial markets.
Okay, so financially, they seem to be managing the growth well. But it's not just about the money or the megawatts, is it? They also talk a lot about ESG, environment, social governance, safety, too.
Yes, they definitely highlight that aspect. They point to being part of the FTSE 4Good index and getting a top A rating for ESG from MSCI, which is sector leading.
And they have specific targets for 2030.
Very specific, ambitious ones. Carbon neutral by 2050, but a 50% cut in emissions by 2030 compared to 2020. No net loss for biodiversity. Getting renewables up to 2/3 of their total capacity.
Water and waste, too.
Yep. Reducing water use per unit of energy, hitting 100% ash utilization from their thermal plants, and achieving zero liquid discharge. Big commitments.
And how did they do on those fronts in Q1?
Well, they reported hitting that 100% ash utilization mark. They also noted reductions in CO2 intensity and emissions like PM, SCOX, and NOx. On water, they mentioned ongoing zero liquid discharge efforts, a water neutrality study at Barmer, and using dry robot cleaning for solar panels to save water.
Safety.
They recorded a lost time injury frequency rate, or LTIFR, of 0.095, which is a key safety metric. They also mentioned training and emergency preparedness.
Now, you mentioned earlier that things aren't always straightforward. There was something about a court ruling.
Ah, yes. That's a good example of the real-world complexities. The Supreme Court ruling on their Karchamoying 2 hydro plant.
What happened there?
The court directed them to increase the amount of free power they supply to the state of Himachal Pradesh. It went up from 12% to 18%, effective from September 2023.
So an unexpected increase in their obligation.
Exactly. It just shows that beyond the company's strategy, there are regulatory factors, social agreements, things that can change the operational landscape.
That's a really important point. And beyond the environmental and safety stuff, they also focus on community initiatives, right?
Yes, quite extensively. They listed several examples empowering over 8,700 people with skills, a women's empowerment handicraft project winning an award, providing safe drinking water access to over 21,000 people.
Waste management, health, education.
Right. Impacting nearly 18,000 lives with waste initiatives, over 27,000 with health programs, helping over 3,400 students access quality education. They also mentioned sports programs and support for farmers. It's a broad range of community work.
So a strong quarter, operationally and financially, clear future strategy, and a stated commitment to ESG and community. Let's zoom out for the final piece. How does all this fit into the bigger picture? The Indian economy, the energy market overall.
Right. Context is key. JSW Energy isn't operating in a vacuum. And the Indian economy, well, it continues to show resilience. Real GDP growth was strong in March 2025 at 7.4% year over year.
And the forecast for FY26.
Expected around 6.5%. Manufacturing and services PMIs were healthy in June. GST collections were up. And importantly, inflation was low 2.1% in June, a 77-month low, well within the RBI's comfort zone.
So a generally positive economic backdrop.
Yes, which helps support energy demand, generally speaking.
But what actually happened with power demand this quarter?
Interestingly, overall power demand in India actually dipped slightly in Q1 FY26, down 1.5% year over year to 446 BUs.
Down. Why was that?
Mainly due to a high base effect from last year, plus the monsoon arriving a bit early this year, which tends to reduce demand for cooling. Overall generation was also down slightly, by 2.0% year over year.
But within that overall picture, the mix of generation is changing, isn't it?
Absolutely. And this is crucial for JSW Energy's strategy. Renewable energy generation, excluding the big hydro projects, increased by 21% year over year.
21% growth for R.
Yeah. Solar was up 18%, wind up 32%. So even with slightly lower overall demand, renewables grabbed a bigger slice of the pie. The thermal share actually dropped from 77% last year to 72% this quarter.
That really highlights the shift underway.
It does. The transition is happening.
And what about the merchant market? The spot prices for power?
The day-ahead market, or DAM, prices were actually down 16% compared to last year, averaging 4.41 per kWh.
Lower prices there.
Yes. And the volume cleared specifically in the DAM was down a bit too, 7.4%. However, total cleared volumes across all market segments were up 17%. So more trading overall, even if spot prices were softer.
Which brings us back to JSW Energy's strategy.
Exactly. Their big push towards long-term PPAs and expanding in renewables looks even smarter against this backdrop. It shields them from that merchant market volatility and aligns them perfectly with the grid's shift towards cleaner energy. It's about adapting proactively.
So summing it all up, JSW Energy's Q1 FY26 really does look like a landmark quarter. Significant growth financially, operationally, driven by smart acquisitions and a very clear pivot to renewables and storage.
And they're doing this while keeping their finances relatively healthy and maintaining a strong focus on sustainability and ESG. It's quite a balancing act.
It really is. Which leaves us with a final thought for you, our listener. As JSW Energy charts this ambitious course towards 30 gigajoules of generation and 40 gigajoules of storage by 2030, consider this. How will India's evolving energy policies, coupled with innovation in technologies like battery storage and green hydrogen, ultimately shape not just JSW Energy's future, but the entire country's path to energy independence and a sustainable environment? Something to think about.